Stocks trade ranged with advances and declines almost evenly balanced ahead of the weekend. Metals gain while energy drags.
The Petroleum and Natural Gas Regulatory Board, PNGRB, approves an upward revision in its tariff by 12% against the 20% expected. The next tariff review is expected only in FY28. The stock slips on the disappointment.
Online retailer Meesho announces its 5,400 crore rupee IPO, eyeing a valuation of near 50,000 crore rupees. The e-com leader expects higher ad revenues to drive up cash flows as it expands, even as it rules out charging users a commission.
Silver scales to its close to its all-time high of around $54.5 per ounce as high industrial demand and strong investment interests point to a significant deficit. Hope of a rate cut by the Fed Reserve further aids sentiment.
Hello and welcome. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me as always, Ekta Batra and Vinny Motiwala. The market's holding up fairly well. 26,250 after hitting a record high yesterday. No problems. One would say that, one would have wanted a bazooka move, but that wasn't the case. We're not in that market right now. All four indices above our head. The fact that they're in the green is great enough, I guess.
Hi guys, yes, absolutely. We have the mid-cap index, which is just about consolidating at this point in time. The bank Nifty, which is up around 0.2%. But let's see what takes place with the GDP data, which is due at 4 p.m. this evening. So the street is expecting that maybe it's not going to be as great as the 7.8% that we saw in the previous quarter, but we are expecting a figure above 7%. And not to mention maybe around 7.4%. So still strong, but not as strong as the previous quarter is what the expectation is. So let's see how that plays out on Monday's trading session. But as of now, just about consolidating at around 26,246 for the Nifty.
Hi guys, good afternoon. Yes, that's the date today. But when you look at it for the week, right, the Nifty, when you're looking at it and watching out for, has managed to see some bit of a gains of around 6/10 to 7/10%, while the broader end of the market, the Nifty mid-cap, that's managed to see a bit of an outperformance in this week. That's what I'm looking at, and changes this week. So that is interesting to watch out for. While in terms of overall performance today also, what we're seeing is that IT very, very flat in trade. Nothing sort of an excitement coming in there. So that is something that we will be keeping an eye out on. A lot of movers today are coming from Wellspun India, SRF, Varun Beverages. Some of these broader end of the market names are managing to hold on to gains. And in that, one important stock that we're putting the spotlight on, or is important to watch out for, is GAIL. That has slipped as much as 6% in today's trading session. Why? This is coming after PNGRB has revised the tariffs. Now, Sonal is joining us to give us an update on this one. Afternoon, Sonal.
Good afternoon. Yes, GAIL is in focus because there is a disappointment that has come by. Now, do remember there was an expectation of a tariff hike. It has come in. It is a 12% hike that we're looking at for GAIL for its transmission pipeline, but it is lower than what the street was anticipating. The expectation was of a 15 to 20% hike, and GAIL had asked for a 33% hike, right? So it's way lower than that. However, the PNGRB, the regulator, says that it's only an interim relief that has come by. There will be another round of tariff hike in 2028, which will be applicable from 1st of April. And that is when they will be considering other factors as well, because right now they have not taken into consideration actual and future operating expenditure and capital expenditure for setting up these pipelines as well. For now, it just has been the capacity utilization and deallocation of APM gas, so some costs around that. So it has come in as a disappointment, despite the fact that there's an expectation of another price hike that could come by in April. ICICI Securities says that yes, it is a disappointment, but still there's an upside risk if the tariff in April 2028 is higher than what the street is working with. What are the brokerages making of this move? UBS, which has a buy rating and a target price of 215 on the share, they say it is a disappointment. An increase in realized tariffs could even be lower after considering some of the costs. 12% hike is announced in tariffs, but actually the hit on the PNL or the improvement on the PNL could be much lower. But the regulator has deferred review of other parameters to FY28, and this is something which could lead to material increase in tariff, and that would be something that will impact the customers. And this is something PNGRB also indicated that they wanted to smoothen out the process and not burden the customers at one go with tariff hikes. Citi has a buy rating. They say this is below the 15% mark that they had built in their parameters and forecasts. It is below 33% as well, but this should also set to motion implementation of the new unified tariff regime, which will be positive for something like an IGL. Jeffries has gone ahead and increased their EBITDA estimates by 7% for the next 2 fiscals because they believe it is in line with what they were working with, and they are quite positive on the stock with a target price of 230 rupees a share.
Okay, all right. Thanks very much for that, Sonal. So GAIL in focus. But in fact, we did speak to PNGRB earlier today, and they told us that this is just an interim relief and that tariffs will be revised in 2028 again. Listen in.
We have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all true up all the factors, capex, opex, pay, relief, everything we will give. 2 reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas, of APM gas by the ministry. So these are the 2 basic reasons, and wherein we have determined the tariff of 65.69, considering all the 3 factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL.
Okay, all right. Well, that's GAIL. The stock is down around 5% but that was the PNGRB talking to CNBC-TV18 earlier today. To understand the impact further, we did speak to Rakesh Kumar Jain, who is the Director of Finance at GAIL, and the company tells us that this has been lower from what was in fact sought.
We submitted our tariff of 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles or parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So in this case, PNGRB asked us to file the midterm review, and we filed it. It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees per annum. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70, 72 rupees, but it has come down to 65 rupees, 69 rupees. There is a gap from our expectations of around 5, 6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Okay, on that note, we're going to actually sip into a very short break. Up next, we'll get you excerpts from our exclusive conversation with Meesho on their upcoming IPO.
Well, let's move on to the primary market action right now. What we're looking at is the start of or the launch of the IPO of Meesho. 50,000 crore valuation is what the company is seeking. The price band that it is set for its 5,400 crore rupee IPO is 105 to 111 rupees. Rima and I caught up with the management and began by asking them about the IPO, the revenue mix, the value left on the table, and at what point do they turn EBITDA profitable. Here out.
So we actually make money from the services we offer to our merchants. Like number one is logistics. Over time, we've basically built the most efficient, lowest cost logistics in e-commerce in India. And because of that, we're able to make a margin there. And we also make money on advertising. So our sellers now have like ad products to basically promote their listings across the platform. And when they use those ad products, we get paid. So these are the primary ways of how we make money.
And what's the split between fulfillment versus advertising to your top line?
So we don't share that split. We haven't disclosed that in the RHP.
Guys, welcome to the stock markets. Now, everyone will be asking you the more important number, which is beneath the top line. It's the operational profit and the net profits. Yes, you guys are contribution positive. Your, business is growing fairly well at a 28% clip. When do you turn profitable on an operational basis and the net profit basis?
I think in terms of profitability, the most important metric that we optimize for is free cash flow. Like if you look at any company that's actually valued at the net present values of the free cash flow generates over the long term. So instead of any other operating profit metric, the most important thing for us is free cash flow. If you look at the last 2 years, we've been free cash flow positive. Right. And I think that will continue to be a focus area even going forward. We always take a very long-term view of our business. We believe we can keep growing our business at the right pace while being free cash flow positive. We'll kind of generate the right value for our shareholders in the long run. So that's our big focus area.
Your adjusted EBITDA in H1 is 551 crore as a loss, which is more than double of the whole of last year. Can you explain what led to the widening of the losses?
I think a big focus area for us this year was we saw our value proposition becoming much, much better. And because of that, we saw our payback periods were quite attractive for a lot more customers. So you would see for the first 6 months of this year, we grew at a very fast pace.
Much more than what you've done earlier in the last 2 years as well. What caused that?
I think over the last 2 years, our value proposition became much better. With Valmo scaling up, our costs went down.
And you had the IPO on your mind as well?
Actually, it's not that we do anything for an IPO. If you see, just for the last 2 years, our FY25 growth was faster than our FY24 growth, and then 6 months are faster than the last year. So it's a consistent story for now about 24 months. And if we feel like the payback periods continue to be attractive, we will push the pedal and want to grow to a long-term, steady-state annual transacting user base sooner than later.
So I think how has your customer acquisition cost moved over the last few years, and how has your customer payback period come down over the last few years?
So if you look at 3 years ago versus where we are today, the cost of acquiring a customer for us has come down quite significantly. Most businesses, if you look at it, cost of acquiring customers only increases as time passes because it becomes harder to go deeper and deeper into the customer base. And that's why we are able to press the pedal on growth and grow our customer base even faster.
Sanjeev, will you all continue to push the pedal on growth? Because H1 growth is higher than the growth of last year. And I was just reading from the RHP, the spend to convert a new consumer declined between FY23 to FY25 by about 27%. But in the first half of the year, it increased by 52%, which means you're making a very conscious effort to get more customers. Your cost of acquisition seems to have gone up. And even from the fresh issue, more than 1,000 crore is on marketing and advertising. So clearly, as you said, there is an intentional push to drive growth, which we saw in first half. How long will that continue?
I think as we continue to make our value prop stronger and as we continue to innovate across different cost headers in the business, right? We continue to make the business model more efficient across logistics cost, other types of cost. We continue to invest in AI as well extensively as we continue to go deeper in India, right? Like it's also important to make the shopping experience extremely simple. And as we continue to just make the platform better, I believe that's the right thing to do for the business.
I just wanted to understand from your standpoint, how opposed are you all to actually introducing something like a platform fee? Because just mathematically speaking, you guys, last year did what? Close to around 183 crore orders that were placed. This year, first half, you've done nearly 125. You annualize that closer to 280 thereabouts. Even if you charge a 1 rupee platform fee, That's straight 280 crores to the EBITDA. Why are you morally opposed to that? Or are you?
I think we are actually, and I would say we've been a very, very customer-focused company from the beginning. And we believe it takes a lot of effort to earn the trust of your customers. And anything which basically goes against some of those principles, we'll not do. There could be many ways of like making like a lot of money in the short term, but if it trades off with some of our principles, we actually don't want to take that.
But you're
road.
not profiteering out of them. It's a platform that you're providing them, and it's a legit service that you're providing them.
I think, again, that's the thing, right? Like if you introduce something at the end to a customer and they come onto your platform, they look at a particular price and they suddenly get a surprise at the end, it can that's the thing, right? Like it's the trust. You can't put a number to the trust. Like at what number do you break the trust and at what number do you not break the trust? I think some of this comes less from A/B experiments. It comes a lot from principles, right? Like that you believe in. For the longest time, we've been very, very, like people always believe for the longest time that at some point in time we will get rid of zero commission. They said, hey, why don't you make some, like X percentage? And we never did it. Right, and same thing holds true here. I think it takes a lot of effort to earn the trust of your ecosystem, and you want to make sure that trust stays, right? Like because that's the only way you will create value in the long term.
At what point does the average order value, which is now 265, 270, hit a trough? It can't keep going lower. So what's in your assessment?
So I think, like Vidit mentioned, first of all, on all of our orders, be it low-priced orders or high-priced orders, we actually make positive contribution margin, roughly similar contribution margin. So for us, it's a lot more about how to mimic the behavior that consumers have offline. If you look at India, most consumers transact very frequently in small amounts because that's how their own sort of cash flows are, and that's how they have been consuming in the offline world as well. So as we make more and more price points affordable by reducing the logistics cost, this number might come down, but we will still be profitably serving those orders. And, it should mimic how India consumes in some sense. We don't have a specific forecast on that.
So what are your contribution margin levers? Because the first half of this year, it's been about 3.8%. The last year was around 5%. How do you grow from here on the contribution margins?
So I think the philosophy there would be that, the ad revenues, which are still much lower for us in relation to how the overall sort of emerging market base is, those will continue to grow. If you look at most other emerging market e-commerce platforms like Pinduoduo or many others, they have seen much higher growth of ad revenues, and a lot of those ad revenue growth comes when the platform is, much larger, the annual transacting user base.
You are already the largest, come on. You have to increase that a lot more.
Yeah, but I think the scope that we have from a headroom perspective is also quite large.
How much is it as a proportion of your overall revenue right now?
So if you look at the global benchmarks, this would be somewhere around 5% of GMV levels, right?
Okay.
So
and yours is lower.
Ours is lower.
What are the steady state contribution margins you're aspiring for?
So I think it should be closer to where the global benchmarks are.
That
I
is?
think
Mid-single digits?
global benchmarks tend to be about 8 to 10% of kind of NMV. So it should be in those lines.
And what value have you left on the table for people? I have to ask you this because it's 5x sales. Yes, you would say, okay, Eternal is 13x, you have Swiggy, which is 6x, Nykaa is about 10x, all the others are around 9x, you are closer to DMart, but then you're nowhere closer to DMart's profits as well, right? So at 5x sales, how much value do you think you've left on the table?
So I think our objective has been to, first of all, get the right quality of investors as part of the IPO. We have been a private company. Now when we are turning public, I think the foremost objective that, let's say, Vidit, Sanjeev, the board had was that how do we get the most high quality long-term shareholders into the mix, be it domestic investors, foreign investors, sovereign wealth funds, etc. And at what value are they, attracted to the offering? And that's been the defining function. So when our bankers kind of presented to our board saying at this valuation level, most people are comfortable, and then the board kind of took that on as advice and agreed on this valuation. So we believe it's an attractive one, and we'll see it play out.
So that is the management of Meesho. IPO opens on 3rd of December to 5th of December, 5,400 crore IPO approximately there. But let's move on and talk about the important stocks that are moving around in today's trading session. We have Vivek to take us through the list of that buzzing stock list.
Well, thank you so much for that, Vinny. An action-packed day, quite a lot of movers, especially in the broader end of the markets. The bread largely positive. First on the list has to be Paytm. Our colleague Nimish pointed out a significant upgrade coming in from Goldman Sachs. That particular stock high by close to 3% today. IMFA, one stock from the broader end of the markets that we don't talk about too much, but a global, ferrochrome player in South Africa has actually shut down shop. And analysts say that this could lead to significant benefits as far as IMFA is concerned. Poonawalla FinCorp, good volumes today, one of the top gainers as far as the NSE 500 is concerned. And SRF, after a while, this chemical company, after an Access Capital upgrade, stock have close to 4%. And Eureka Forbes, yesterday held a management meet. Very good commentary coming in from the management, especially as medium-term targets are concerned. Stock high by close to 10%, a significant move coming in on Eureka Forbes. On the other hand, quite a few laggards as well. Voltas, been a very volatile last couple of weeks for Voltas today on the lower side among the top F&O laggards. MCX now, here it's seeing a significant fall today on high volumes. Some of the newspaper reports are actually indicating that a lot of data has been asked from brokers regarding the F&O P&Ls from clients, and this has led to a bit of a concern. Stock low by over 4% today. Angel One, again, this particular stock in the NSE 500 index seeing significant selling pressure. Sri Cement, over the past few days, a lot of ground checks have indicated that cement prices have remained soft, low by over 1%. And yet, you did see a large block deal take place. This particular stock on high volumes today hasn't recovered much after the block deal.
Okay, all right, Vivek, thanks very much for that. So those are a lot of the buzzing stocks. And just to add to that list, when you're talking about new companies, IPOs, primary market, we have a new listing, Sudeep Pharma, today as well. And that's listed extremely well in today's trading session. It's up around 28% off the day's high, but nonetheless, strong listing. It was subscribed around 94 times in terms of a total subscription, raised around 268 crores from anchor investors as well. Well, we'll take a short break, but up next, we'll get talking about the technicals of the market. Shrikant Chauhan will be with us. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Let's take a look at the happenings from the F&O desk. Well, the frontline indices holding fairly in the green. Not a big bazooka sort of move, but we've seen some sort of consolidation from record highs yesterday, and that was pretty much expected. Mid-cap index is slightly under the weather, as it was in yesterday's trading session as well. And that's something that the advanced decline has been indicating all through the course of today's trading session as well. Largely undecided between red and green, flitting around the flat line and split right down the middle. But the good part is that with the markets moving higher, there has been a moderation in the VIX. So the India VIX is down by about 4%, and it's sub the 12 mark, which is extremely important from a volatility level standpoint. And now as we speak, even as the market consolidates at these levels, put writers are more active than call writers, telling you there is stronger support than an upside resistance. So we have the 26,200 put, which is fairly active, premium of almost 70 rupees on that one. 26,250 put as well, equally active, and the premium out there is close to around 100 rupees. What does that tell you? Around 26,150 to around 26,170 is where you are likely to see strong support for the frontline index. Though, as we move towards yesterday's high, closer to 26,310, you might see some supply come in. That's the sense one gets when one looks at the premium at the 26,300 call at around 67 rupees. So around between 26,300 to 26,350 is where the resistance is expected. Though a lot of individual stocks are fairly well long bid today. You have names like Varun Beverages and SRF, both of them up in the tune of 3.5% to 4%, and a lot of open interest backing that. So long build up out there on those two counters. And GAIL, that has been the stock of the day on the way down, and understandably seeing a lot of short positions being added. Nearly 38% jump in open interest. Will be interesting to see whether it enters the F&O ban or not, but will be very crucial to track how GAIL progresses from here on.
Okay, thank you so much for that, Mangalam. We'll keep an eye out on those names over there. But we have some update that's just come in on the IEX and CRC case hearing that's there at the appellate tribunal. Now, seems like the IEX Council is mentioning SEBI's order with respect to insider trading. It's also highlighting that the order mentioned few CRC officials in insider trading. We'll wait out for more updates here. Here's the latest that we have coming in here for IEX and versus the CERC case in terms of the challenge that, they challenged the CERC's order, IEX. So now we'll wait out for the market coupling hearing, finally what happens here. But let's move on. And Sudeep Pharma, Ekta, you were talking about it as well. Yeah. Talk to us about the company as well. Listing has done well, but what is the reason behind this bumper listing?
Well, yes, 29% gain is what you are seeing for Sudeep Pharma. Now, it's a strong listing, like you mentioned. It manufactures pharma excipients, food-grade minerals, specialty nutrition ingredients, and it's present in over 100 countries. 2/3 of its revenue comes from pharma, food nutrition, specialty ingredients is around 1/3, which is a newer segment that they've come out with. 80% of annual revenue is, in fact, from repeat customers, according to them. They have manufacturing facilities, a total of 5, which is 4 in India and 1 in Ireland. Now, like I mentioned, they did close with a strong subscription. So they were subscribed a total of around 94 times. They've raised around 268 crores from anchor investors. So totally, the company, in terms of its IPO, has raised around 895 odd crores. OFS is around 800 crores. Fresh issue of around 95 odd crores. Now, the proceeds will be used for procurement of machinery for production line, which is located at one of their facilities. It's valued at around 45 times plus trailing FY25 PE. So the company says that as of now, there's no listed peer whom they can compare themselves to as we speak. So that's Sudeep Pharma for you. If you look at it on an FY25 basis, revenue is up around 9%, EBITDA is up around 4.6%. Margins also margins declined a little bit, and we have profit, which is up around 4% for the year. Now, the company says that 75 crores will be used for capex expansion of iron phosphate, which is basically an ingredient which goes into children's nutrition, etc. It's also started a new vertical called specialty ingredients, like I mentioned, which has grown to around 170 crores. So it's a higher margin business. And iron phosphate in India has limited approvals, like I mentioned. So it is an opportunity for the company going forward. Well, we'll take a short break, but on the other side, Manisha Gupta will be with us. She's going to take us through a conversation on the other side. Stay tuned.
Welcome back. Joining us on the show now is Krishna B. Goel. Mr. Goel, thank you so much for joining in. And it really seems to be silver that is making headlines right now. We're trading at around all-time highs, $0.50 away from 54.5, really 88% of gains in this year, best year in last 10 years and more. As has been the case in gold, with the price rise, the volumes have declined. Would you say that really is not the case with silver? There are buyers and some more buyers now coming in.
You see, basically, as I told you even previously, that silver is being used also a lot in industrial sector, like all the electronics, the EVs that we are making, all the batteries. So the consumption of silver, actually, if you see, it is much higher than the actual production. In case of gold, yes, the consumption has gone down because there are less buyers now. But in silver, it is on increasing trend.
I get your point, Mr. Goel, that industrial demand has been increasing. But what about the investment demand? Because we're looking at newer category of people now coming in for silver with the kind of returns it's given.
Yes, you see, everyone sees that there will be a good increase and good return on investment even in silver. That's why if you look near Diwali, there was no silver available in market. And the premium in Indian market went up to 40,000 rupees, which was unprecedented. So the new category of investors is jumping into this category for investment purpose, but at the same time, the demand for jewelry, because lifestyle is changing with weddings being done out of their own town, destination weddings. Everyone wants to have jewelry which is safe and which they can easily wear, So silver, even in terms of jewelry, the demand has increased. In industrial use, the demand has increased. So there is all positive signs. I mean, almost 7 to 8% production is less than the overall demand.
Oh, absolutely. In the Indian context then, Mr. Goyal, are we looking at more people investing as in sense of industry as well? Until now, it has been about diamond jewelry stores and gold stores. Are we looking at more single silver stores coming up as well?
You see, this trend will certainly will be up. If we look at the West, there were a lot of gold buyers, and the shops were only selling gold or diamond studded jewelry. But slowly, the trend changes, and there were single stores for silver jewelry and the articles. So India will see the dramatic change because of the lifestyle and the new generation, which won't use jewelry for their everyday use. Today, everyone is not looking only for the investment, but also for personal adornment. So that shift is being noticed strongly from in last couple of years.
Mr. Goyal, what is your sense also on prices from here? 87% of gains already. If you look at the last 2 years, it has been 165% of gains. So silver clearly has been on fire for the last couple of years. How is the outlook now for 2026?
You see, basically, it will keep on increasing, maybe not that speedily as it has been in past couple of years. But since, as I told you, that the production is less, demand is more, so the trend will continue to upwards.
Mr. Goyal, the kind of buying that we've seen in Indian markets, jewelry you already have spoken about, and then of course the investment demand in coins and bars is another thing. But would you say the usual silver purchase in India that clearly has been about utensils and statues, etc., is that continuing as well at these current levels?
You see, Manisha, if you remember, I mean, I remember from my childhood, every Diwali, every Dhanteras, my grandfather used to buy silver coins. So in Indian culture, the silver has always played a very important role. In our houses, we see that even in our daily uses, we use a lot of silver glasses, silver mugs, So the articles per se will always be in demand in India.
Oh, well, absolutely. Very well said. Yes, when it comes to silver, whether it's about investment and bar coins, gifting, it has been a way of culture and, of course, investment and now industrial demand as well. So absolutely, the prices are expected to continue to go higher from here. Mr. Goyal, as always, thank you so much for taking time out and joining in and weighing in with your sense on where the silver perhaps could be headed. Well, with that, let's go for a short break. When we come back, we'll talk more about markets and, of course, the second quarter GDP and what's expected from that one today.
Now markets 26,200 levels, around that is what the Nifty trades at. But let's move on and talk about the second quarter GDP numbers that are due today. Maybe almost an eye-popping as Q1 GDP. A CNBC-TV18 poll sees Q2 GDP growth now at 7.4% versus 7.8% in Q1. Hence, most economists have raised their full-year GDP growth forecast to about 7%. Lata, looks like a good show today, right?
One reason why it's good is look at the year-ago number, 5.6%. That was a terrible second quarter we had. So it's perhaps easy to look good because of that. And it's a tad lower than the 7.8%, which was a genuinely eye-popping number which we got for Q1. However, this is real GDP is what we are talking about. That is, we are taking away the price effect. We're only looking at the rise in goods and services. If you add the price effect, what you call nominal GDP, that's growing at only 8% versus 8.3 year ago and versus 8.8 in Q1 and versus a union budget assumption of 10.8%. So clearly there are going to be problems because of that. The growth at the moment, let us look at the good news. The real GDP growing by 7.4 is going to be helped by all sectors. That is agri, manufacturing and services. Agriculture is seen growing at 3.5, which is very good for agriculture. There are limits. You can't expect it to grow at 8%. Manufacturing, very good, expected to grow at 8.9%, partly because of the front loading of exports and a very good capex spend by the government. Both those helped manufacturing, and services also doing very well at 8.1. Largely finance, real estate, trade, all of them did well. The poll for Q3 and Q4 are also in, but they're preliminary numbers. Q3 is expected to grow, that is the current quarter, at 6.7%, and Q4 at 6.3%. For one thing, they also have a high base, especially Q4. But most of the economists said these are subject to change after we look at the Q2 numbers. Overall, if you average it out, the full year number comes now at 7.02, which is very good, because if you remember the CEA, when he presented the economic survey before the budget, he said he expected 6.3 to 6.8. The most optimistic number was 6.8, but now economists are saying it can be above 7%. Again, nominal GDP is the worry. It is going to grow by 8% according to our poll. Nominal GDP is important because that is what gets counted in the budget. That is what gets counted in earnings forecasts of companies. You don't take out the price effect. You just take the profit. Now that, if it is overall is growing only at 8%, you have a problem. There could be an earnings growth problem if nominal GDP is that low.
Take that point, Lata. Thank you so much for laying that down there for us. We will obviously watch out for the number as it comes by after markets today. We take a short break, come back, focus on the markets once again. There is consolidation which continues. The Nifty now marginally in the red as against being marginally in the green in the previous segment. Take a break, come back, more on the markets.
Welcome back. Well, for the markets, it's absolutely flat. But if you look at specific stocks on a week-to-date basis, if you had invested in, say, Hindalco or TechM at the start of the week, you would be sitting on gains of around 4% to maybe 3.5% at this point in time. And conversely, on the negative side, the top two losers on a week-to-date basis stands at Adani Enterprises, which has lost around 4.5%, and SBI Life, which has lost around 3% as well. Well, on that note, it's a wrap on the show on Halftime Report. Stay tuned. Business Lunch just after a short break.